Hello there again, everyone. This is Greg Towner with Parallel Financial, and welcome to our monthly Outlook video call. Some of the things that we're going to cover this month include another look at the U.S. and international, as well as emerging markets price trends. Are things continuing to be healthy? We want to take another look at the earnings and sales trends. We've pointed out that those have been strong. Is that still the case? And then lastly, we want to look at the health of both the consumer and the corporations as well. So let's start with a broad view of the U.S. equity markets. This is the S&P 500. We wanted to take a step back and a little longer term view. This is a 10-year weekly chart. So for reference, down here in the corner is the financial crisis of '08 and '09. You can see since then, with some corrections along the way, we've been largely in a nice uptrend. You may recall back in late 2015 into 16, we had a couple sharp corrections and had this big sideways movement. Of course, we've since broken out of that and have resumed the uptrend again. Some may argue that we're a little bit extended above the moving averages, and that's possible. Maybe we have a pause or correction at some point this year. There's no way of knowing for sure, of course. But for the time being, most importantly, we're still in a nice, healthy uptrend well above our moving averages. Now, last month we talked about the broader international developed markets, and we thought those were acting real well. So this month we thought we'd take a look at the more emerging international markets. This is a 3-year chart of the emerging markets. As you may know, there's been in a downtrend for a few years. Spent last year or so really kind of basing out, starting to end the downtrend, and now we believe it's entered a new uptrend. We can see that it broke out to new recent highs. It's acting well above its major moving averages. Another reason that we're positive on a lot of the international markets and not just U.S. markets. Now, one thing that we want to look at, and we have been looking at, is the growth of earnings as well as sales. And when we looked at that first S&P chart, we pointed out how the 2015-2016 period really kind of had a couple of corrections and really didn't go anywhere. Well, it's really no coincidence that when we look back at earnings over the last, going back to 2011, we saw a lot of growth for a while. And then during that 2015-16 period where the market didn't perform well, actually had negative earnings growth there. We got positive last fall, partly because earnings growth started to move higher, and we can see that continue. I don't know if we're going to continue to see 15% growth continue, but for the time being, we'll take it and continue to monitor it. Importantly, it's not just earnings, which some argue could be manipulated in certain ways by corporations. It's also top line, sales growth. Again, in 15 and 16, we saw a little bit of negativity there. Since then, we've seen some nice positive growth. Not as high as 2011, like it is with earnings. And we might see a better boost in growth if we perhaps get some tax reform policy cut. We think some corporations are kind of waiting for some of that to try to spend on productivity and growth. But for the time being, we'll take the fact that we're getting some top line growth. Now, for those of you that read our monthly Viewpoint report, you may recall that one of the bullet points that we use for being bullish is the fact that the consumers and corporations are really, their balance sheets, so to speak, are really quite strong right now. So we wanted to show you some examples of that. Now look at this top chart here. This is the debt payments as a percent of personal incomes. How much is debt having to be paid out by consumers? So we can see here back leading into the financial crisis, really reached an all-time high. They're having to pay a lot of their income to debt. Now we're at an all-time low, only about 10%. So you can see we're actually lower than going all the way back to the 1980s. So really the balance sheets for consumers have improved a lot. One other view of this is really just the household net worth. This is certainly expected to increase over time as the price of their holdings in stocks go up and real estate and all of that. But we had a big correction in '08 and '09, and it's continued to move higher since. In fact, we've recently reached an all-time high for consumer net worth, household net worth. Importantly, corporations are in really good shape as well. There's a lot of different ways to look at corporations, of course, but just this one chart we thought we'd share with you. Their cash is a percent of current assets. It increased quite a bit until the financial crisis, where it kind of flattened and dipped out a little bit, surged out of that period. And it's flattened out a little bit, but it's really still at or near all-time highs. So corporations are really flush with cash. We'd like to see them spend that a little bit more, try to boost growth. But again, we think if there is ultimately some tax policy change, corporations are kind of waiting on that before they they open their wallet, so to speak. So those are the main things that we wanted to cover this month, but let's review it in summary. Market action, we think, remains healthy. There's a lot of noise out there around headlines and, of course, DC and various international geopolitical events and so forth. But the bottom line is, what are investors doing with their money, and what is the actual price movement of the market doing? And so far, trends continue to be strong. And we think the earnings and sales growth story is going to be, or has been, at least as important as policy change, and probably more important, as we reflected how it hurt the market in 15 and 16 when we didn't have growth. Now we're getting it. Hopefully that continues. Perhaps we'll get some policy shifts to help it further down the road. And importantly, consumers and corporations much better positioned now to handle the next economic down cycle than they were leading into the financial crisis. We don't know when the next recession will occur. It doesn't feel like it's imminent by any stretch, but ultimately there will be another one. That's a natural economic cycle. So it's comforting to know that consumers and corporations are in better health now to be able to handle that when it does come, so that it's hopefully a so-called normal, moderate recession and not another crisis, so to speak. So thank you for joining us this month. We hope your summer gets off to a great start, and we will speak with you next month. Thank you.